Hello, my name is Thomas Schwingle, and I am a professional cinematographer based in Los Angeles. I'm making this 6-part series of videos for freelance filmmakers, creative gig workers, and small film businesses, figuring out the nuances of contract work versus being a short-term employee is confusing. Taxes are complicated. Invoicing and dealing with contracts from a studio can be intimidating. This is not legal advice or professional tax advice. Please speak with a lawyer if you need specific consultation, and please do your own due diligence. My opinions and tips are not the only way to structure your plans. However, after many years of running my cinematography trade across multiple states, I've learned a lot and often get asked by others for input. I'm sharing what I know because I haven't seen a lot of other videos that do it. This is video number 5 of 6 in this series. In the previous video, I discussed invoicing. If you do a lot of invoicing, or predominantly do invoice work, then you're going to be on the hook to pay your own income taxes, which are traditionally taken out of a paycheck when you are working as an employee. I'll do a brief explanation of taxes here, but this is not professional tax advice or legal advice. When you invoice, you are likely getting a check without any withholdings. It is incumbent on you to pay income tax to both the state in which you worked and to the federal government. And, depending on how your business is structured, you will owe the self-employment tax, which pays into the Social Security and Medicare systems. If an individual only does 1 or 2 invoice jobs a year, or only expects to owe about $1,000 or less to the federal government in outstanding tax, you can probably pay this around tax return time in April. How do you determine how much tax you owe? Well, it's not straightforward. The IRS has an online calculator you can use, and some states probably offer a calculator of their own, or at the very least, a form sheet that allows you to run some equations that help you determine how much you owe. But in all honesty, it's hard to nail it. If you've done a tax return as a freelancer, you know all of the things that go into it. There are write-offs for when you buy equipment. There are costs to operating a small business. You may have student loan payments or property that the business operates, which can incur expenses. These all affect how much apparent income and/or profit you made that year. The more business costs you have, the less profit you made and the less tax you owe on the income. You've probably heard of some peers who had a good work year and then buy themselves pricey equipment before the new year as a write-off. They might buy themselves a few brand new sets of Sennheiser wireless lavs, and that expense can offset their tax liability. So how do you estimate what you owe? For your first year, you may just have to use the complicated online calculators or forms. After you've run your business for some time or have done a few years in a certain crew position, you may get good at knowing roughly what you owe. I am at the point where I can throw a basic percentage at my income and get pretty close to what I owe in taxes. Everyone likes getting a fat tax return check from Uncle Sam after you file your yearly tax return, but what that really means is that you gave the government a chunk of your income that was entitled to you, and you weren't earning interest on it in your bank account or spending it on your own needs. The opposite is bad too. If you owe a few grand come tax return time, then you're also likely going to have to pay penalties stacked on top of that. You want to get as close to zero as possible on your yearly tax return paperwork. Either a tiny check sent back to you after filing, or an amount owed to the government that is just a couple $100s or less. Most of us are going to fall into a category where we owe estimated taxes to both our state or states of work and to the US government every quarter, 4 payments for a calendar year. Of course, if you live in a state that doesn't collect income tax on individual income, then depending on your business structure, you may not have to pay this, but please do your own research for the state in which you work. Let's make a hypothetical situation. You are a small business and you shoot promotional videos for musicians. You're only doing work through invoices because it is just you. You're the business. Maybe occasionally you throw a few $100s to a friend to help hold some odd equipment, or you hire a makeup artist. And these are business expenses, by the way, write-offs. But your income is via paycheck payments, either from the manager or label of these musicians. I'm going to make a hypothetical monthly calendar to fit your hypothetical music video business. Here's a spreadsheet. Each month has information for the invoices that you sent out. You have information on when it was paid and how much is expected for that month. Separately, you keep track of how much money came in each month. You can't pay taxes on money you haven't received yet. The year starts slow. You have no work in January. Then, in February, there are 3 days of work, and March also has 3 days. The first quarterly payment is usually due the same time as annual tax returns, on or within a couple days of April 15th, based on when April 15th falls, blah, blah, blah. April 15th, that's the date we all remember. This first payment is calculated based on the income you made between January 1st and March 31st. In this scenario, for the first 3 months of the year, you only made $4,000. Depending on a lot of factors mentioned earlier, such as business expenses and write-offs, the amount of tax you owe on the $4,000 will vary per business and per state of work. If this was my business for quarter one, I'd probably be writing a check of $750 for my federal estimated payment and about $75 to my state of work. Let it sink in. In this scenario, we only made $4,000 for the first 3 months of the year, and nearly a fifth of it is going to taxes. That could be hard to chew if you have other bills to pay. The hope is that you still have money in the bank from last year's work, but if not, the priority is to pay the bills you need to pay. I mean, if you have rent and food and all, you got to keep a roof over your head. You'll just have to rectify this tax shortfall later, although you might face an eventual underpayment penalty for quarter one. The goal is to anticipate your tax payments and set aside the appropriate amount of money to pay your quarterly liability. One of the hardest parts of being a small business or contractor is that you aren't having taxes withheld for you. You have to know that the income isn't just straight profit. You have to save yourself from future penalties by portioning out money for taxes. And the IRS is asking us to constantly guess what we're going to make for that year when we ourselves don't always know. All right, quarter two. Quarter two takes off. You work a full week in April. May is wild. You have 3 different music labels hiring you. June also has a full week of work. For these 3 months, you invoice for $25,000. Payday. However, the tax schedule is a little wonky. Although quarter 2 of the calendar year is usually April, May, and June, for estimated taxes, the IRS is only looking at April and May as the second quarter in regards to estimated payments. The payment for quarter 2 is due on or near June 15th. We have decisions to make. When was the quarter 2 money received by you? Most of it you got in May, but this QWR invoice ended up at your door in June, before estimated taxes are due, but technically outside of the abbreviated estimated tax window for quarter 2 per the IRS. And your June job, invoice SSD002, was performed in June and paid the same day. Also outside of the IRS quarter 2 estimation window, but before your tax payments due. Your income received by you in estimated quarter 2 is $14,500, but you have received all $25,000 in actual quarter 2 just before it's time to make the payment. What a mess, huh? If it were me, I would probably make the payment based on all of the income that I've received up to this point. For one, if we recall, we made very little money at the start of the year, and depending on your financial situation at that time, you may not have paid adequate estimated taxes in quarter 1 because you had all the life stuff to pay for. Also, our income has just ramped up significantly. The next estimated payment for quarter 3 is not until on around September 15th. Do you trust yourself to set aside taxes to pay for after the summer? It's summer. Summer's here. You just made $25,000. You want to spend that. While the $10,500 of June income isn't technically due until September, I don't trust myself not to spend too much over the summer. I'm going to make my quarter 2 estimated payment based on what I have in front of me right now, And then I know that whatever's left in my account is mine, and I can blow it on whatever you blow your money on in the summer. Boats? I don't know, boats. In my own business, this would look like a $4,500 estimated payment to the IRS and maybe about $500 to the state in which I worked. Yeah, nearly $5,000 of that $25,000 is going away as taxes, but the rest is ours, or yours, whatever. Well, what if you pay late? You never pay quarter one or quarter two estimated taxes on the nearly $30,000 you made in the first half of the year. But then September rolls around. Summer is over. And you think, I don't want to get busted on my taxes, so why don't I make an extra large payment in September to cover myself? I've got time, tax returns until next year, I'll play catch up. You will likely get charged fees anyway. The IRS and states look at your income for the whole year and they calculate what you are likely to owe in each quarter. They also look at what you made the previous year and they have an expectation of what your quarterly payments should be. Just because you paid all of your taxes before the final tax return doesn't mean you aren't liable for underpayment in quarters where you skipped. They may not know exactly when you made the money, but they do calculate your income across a year. I recall having a first quarter where I underpaid my estimated taxes for a state. I essentially paid nothing. It was either hard times or I overlooked it, but I had paid enough taxes for the full year. However, I was still assessed a small fee for a quarterly underpayment. If you underpay by just a little in a few quarters, but ultimately pay at least 90% or more of the taxes you owe before the end of the tax year, you are in what they call the safe harbor rule and shouldn't be assessed a fee. But anytime you skip payments, especially early in the year, that's going to work against you. It's actually a little messier and more complicated than what I just described, but the best advice I can give is to try to pay as much as you can in the early quarters and adjust your payments later in the year as you get a better handle on your expected income. One other thing I'll mention again. If you are renting equipment or your company performs certain services where you are required to collect sales tax or use tax on the full amount of your invoice, then you are also collecting and paying forward sales and use tax. And this is likely also each quarter, or more or less depending on how much sales tax you are collecting. The sales and use tax payment is separate and different from estimated income taxes. It's a whole other thing. If you demand it, I can try to do a video breaking down sales and use tax. Costs to running your small business, or costs for being an independent contractor or single-member LLC, can be used to offset your business gains and reduce your tax liability. If you rent dedicated space for an office, that can reduce your tax liability. If you buy equipment for your trade, that is another tax reduction. Even research, such as attending screenings, buying books of your craft, or going to industry events, constitute write-offs, if they are for the benefit and growth of your business. The usual phrase is that the expense must be ordinary, necessary, and reasonable to the operation of your business in order to be considered a write-off. For example, you likely use the internet for some of your business work. If that internet is directed to a dedicated office that is the primary place of your business, then up to 100% of the monthly internet fee could reasonably be deducted as a cost in your tax return. Now, if the internet service goes to your home, where you live, but you also do editing, invoicing, and meetings from your living room, it's just as likely that when you aren't doing office work, the internet's being used for non-business purposes. TikTok, video games, running all the little smart objects in the house, playing music. You can only deduct the percentage of that internet bill that is reflective of the business portion of its usage. It's up to you to make the determination. If you are too liberal in your write-offs, expect a tax audit. All of these potential write-offs reduce the quarterly estimates and ultimately get dissected when you file your yearly tax return. I strongly encourage those of you with complicated businesses to work with a CPA for your tax filing. If you work across more than one state, if you rent office space, if you are routinely renting out equipment, a CPA might be better suited to helping you file your tax return and sort out your deductions. Granted, it will cost you a fee that you can write off, but expect to pay a few hundred each year for tax return assistance. If you file for yourself, just be informed and only write off expenses that are ordinary, necessary, and reasonable. One other tip, you can write off certain vehicle expenses. If you have a dedicated vehicle for your business, like a van that hauls your equipment, then you are certainly in a position to write off the costs of operating that vehicle. If you use your personal vehicle to get to set, to make runs, to take meetings, then you can write off a portion of the use of your personal vehicle. It's the portion that falls under business use. Just driving to set near where you live doesn't count. That's considered commuting. But if you get asked to move around during the workday, or you're making shopping runs for a production, or doing certain business-related activities off the clock, then you may be able to write off some of the vehicle costs. The best way to determine this portion is to keep a driving log. There are apps that can assist you. I still use an old paper booklet, but if you note what your odometer says at both the start and end of the year, and then keep track of any times you're using your personal vehicle for business, then you can work out the percentage of business use you had at the end of the year when you file your tax return. This was just a rough overview of taxes. Clearly, they're complicated. They get complicated fast. Everyone always complains about tax time. Please speak to a qualified professional if you find that you're in need of advice. The next and final video of this series might be the most important and influential to your life. It is about saving for retirement. Yes, boring. Boring to think about when you are just starting your career, but I really wish someone had taught me what I intend to teach you. Your future adult self is going to thank you big time. Thanks for watching this video. I'm just trying to give back and help young creatives and filmmakers do right by themselves and succeed. Nobody wants to get audited, nobody wants penalties, we all just want to make cool stuff and make enough money to live. If you like the video, hit the like button. Subscribe if you want. I intend to keep making content as I see fit and things that I think are important or interesting to the community. Thank you.